How do you cash out your crypto into real estate overseas without losing half of its value along the way? Most casual investors, they just dump their coins into some apartment in Turkey or Dubai and never make money on it. And that's because they're not getting the deals that the locals are buying. Only the ones that are being pushed to crypto bros looking for a fast exit. In the next few minutes, I'm going to show you the mistakes to avoid when buying property offshore and how the wealthy sidestep it by first leveraging back home and only then investing in foreign countries. And most importantly, I'll break down step by step the exact same method that you can use to create an international real estate play for your crypto wealth that not only grows it, but also reduces the risk. With that out of the way, let's dive in. Now, we've made videos in the past about cashing out your crypto directly into properties in Dubai, Turkey, or El Salvador. And listen, if you just want to dump your coins somewhere, that definitely has its purpose. But the reality is that those properties are often overpriced just because they're denominated in crypto. And that real estate is not something that the locals are fighting over or even that expats and foreigners would like to live in long term. Those properties, they exist to make crypto cash outs easy, not to continue to build your wealth. And in many cases, they're actually designed for a completely different purpose, to wash offshore capital from China, Russia, and beyond. You see, those construction companies building those apartments and condos, they actually like working with underground money because those guys don't care if they overpay. They don't mind paying higher commissions or inflated prices because they have a completely different goal: to resurface their capital easily, quickly, and quietly. And the only regular people buying alongside them, often Russians and Ukrainians escaping their war-torn countries. But you in the West, you're not escaping war, you're not money launderers, so why settle on second-rate property that you don't even like when there's a far smarter approach? One that allows you to invest in foreign markets while reducing risk and actually making money on your real estate. And the beauty is, as a Westerner, you have access to something that many foreign businessmen absolutely envy: cheap credit, loans, and robust financial infrastructure. Now let me break it down to you, and no, it is not crypto lending platforms. Now you may be asking yourself, why not just use these lending platforms, borrow against my crypto, and then buy real estate? After all, loans aren't taxed, even in first world countries, and platforms like Unchained, Ledin, and Front.io offer these type of services. By the way, they work very well. There is a twist though. First, they do require source of funds documentation for your coins. If you have it, great. If not, you're going to have to build that business structure with flexible accounting to justify it. The real problem is that these crypto loans are some of the most expensive on the market. You see, the traditional bank will offer you a loan based on your income, your real estate collateral, and your credit score. These crypto lenders, they mostly care about one thing, and that's the price of your coin. And since crypto is extremely volatile, it can fall down 30% in a week, they price this risk into their model by charging very high interest rates. And we're talking about 12% and up. In the traditional lending world, this is called a bridge loan or a private money loan. And they're very fast, but expensive because they're dealing with high risk. And here's the worst part. Even after paying that premium interest rate, they can still margin call your coins. If Bitcoin tanks in a week, they will ask you for more collateral, which doesn't happen with traditional mortgages. If you can't pay up in those 2 weeks, they will liquidate your crypto. Now, I'm not saying that there isn't a place for these platforms, especially if you need to raise cash for a business deal, for a specific property, but if you want to invest long term, especially in an offshore country, it's just way too risky. What the wealthy do is that they use their home financing and only then invest in foreign countries. And let me show you how to do that. Now, on the surface, the best interest rates in your home country go to something called qualified mortgages, which is usually for employees or self-employed businesses. So if you have a salary and you have 2 years of tax returns, a clean bank statement, as well as good credit scores, then you can get a mortgage up to 100% of your monthly income. But there's a catch. That cheap interest rate, it's usually 1 to 1.5% better than other loans, comes at a heavy price. To qualify, you need to demonstrate taxable income. And anybody that receives a salary knows very well how much the government skims from their paycheck. So if you're going to cash out your crypto as a salary in the UK, Australia, or Canada, you're going to get obliterated. You're going to pay far more in taxes than you're going to save on that 1 to 1.5% better rate. So the next best option is an asset-based loan. And instead of looking at taxable income, the bank is going to look at 12 to 24 months of bank statements. And since businesses pay less in tax, if you can demonstrate a consistent monthly income, you can get up to a 50% loan on that revenue. But here's the problem. You've heard me talk about flexible accounting a lot, where you're building a business structure to document your crypto and build that paper trail. The very thing that makes it tax efficient is also what's going to kill your chances at the bank. Because one of the ways that businesses pay less in tax is by writing everything off as an expense, as debt, or as loans. So on paper, you're not making a lot in profits. Sometimes you're not making any profit at all. So yeah, you have $1 million in your bank account from your cashed out crypto, but that's all tied with debt. It's a lump sum, not monthly revenue. So when a bank will see your statements, it doesn't see a stable business. It sees a lot of cash with no cash flow. And banks do not care how much is sitting in your bank account. They care about how much you're generating in monthly income, because that's what you're going to be using to pay off the interest from the loan. And that's also how the banks make money. So unless you have a crypto business that is generating monthly inflows, this won't be the best way how you're going to get the best optimal interest rates. However, let me now demonstrate 2 ways that works for pretty much anybody with a lot of crypto gains. Now, one of the ways to get the best interest rates for your cashed out crypto is through a debt service loan. And this is a great way if you want to buy property elsewhere that is a developed country, because you're going to be working with banks and you want to get those first-tier interest rates. And unlike the previous loan types, where they're looking at your salary, your business, your credit score, or your bank statements, no. In this case, the bank is only going to look at the property that you've bought. Here, I'm showing you just an office building as an example. It can be an apartment, but it has to be 1 to 1.25 times larger than the monthly mortgage rate that you're going to be paying. And if that's the case, you qualify. There is no backstory needed. Now, as long as you're not a US citizen, what you can do is you can move your cryptos into a foreign company like Estonia and use the undistributed active income loophole that I've talked about in previous videos to then use that company and subsidiaries to buy real estate in developed countries with a very efficient tax structure, like in the UK, the US, or Canada. Now, you want to make sure that you structure it properly, because by investing in foreign countries, you usually pay local taxes. You don't want to get hit by withholding tax in the US or deemed distribution rules, so that's why you have to structure it well. As for US citizens, they can take advantage of debt service loans, but you're not going to have the same advantages from offshore companies like other citizenships. When it comes to debt service loans, the beauty is you're only putting a portion of your money up front, and the rest is financed by the bank. And guess what that does? It massively reduces the risk. You can't do this though in emerging markets, because if you've ever asked a Colombian or a Turk, they can't even get financing from their local banks, let alone a foreigner like yourself. And if you do get money from a bank, it's not going to be on favorable terms. It's usually going to be at 35 to 45% interest rates. With the full picture in mind, here is the final approach, the one that I call finance in the West and buy in the rest of the world strategy, where you're buying property in emerging markets, but you're using first-tier financing to get there. And here's how it works step by step. Once you've cashed out your crypto gains through an offshore entity, one that holds your capital cleanly and tax efficiently, you use that capital to buy property in first world countries, such as the United States. Why the US? Guns and banks. Out of every country in the world, the United States has some of the best asset protection, not just legally, but also culturally. And since many of the banks are systemically important, whether you like it or not, they are very robust and offer good interest rates. Factor in a population that is armed to its teeth, and the government will have to think twice before deciding to confiscate anything. Now, once you've bought those properties in cash, ideally ones that are generating rental income, you have two options. Option number one is to take out a loan immediately through the delayed financing exemption to invest offshore. And option number two is to wait 6 to 12 months to get a better term on your loan. Why does waiting give you better terms? Because banks, they look at the purchase price when giving out a loan, not the actual value of it. So even if you may have bought a great deal where the property is actually worth $600,000, but you only paid $500,000 for it, you're not going to get the best terms. However, if you wait 6 to 12 months, the banks are going to take into account the new appraisal for the property, and that increases your leverage. Either way, the result stays the same. You're going to redeploy that capital from the developed country into emerging markets. And the beauty is that now all of a sudden you're buying property in different countries using other people's money and Western leverage. So say that your properties in Turkey don't do too well, the Airbnbs aren't making enough money. Well, guess what? Your US properties are not affected. And vice versa. In the worst case scenario, let's say that the rent from the US properties can't cover the loan and they get foreclosed, you still keep these properties offshore. And that creates a jurisdictional hedge. It's not just spreading your assets, it's also spreading them across different countries, different currencies, and different banking systems. Now, pulling out the capital from the first world country is just the first part. To make this strategy work, you need to know where to put that money to work, how to make it grow. And there are three things you want to keep in mind. The first one being, treat the property like a business, not a retirement home. You have to actually enjoy looking for deals that will generate future cash flow, such as this house that is tied to a vineyard. You need to look at the local market, the occupancy trends, the future yields, whether it's a short-term or a long-term rental, or at the very least, extremely undervalued with future potential upside. And secondly, you want to go for those countries that aren't currently being promoted, the ones actually that people are thinking about running away from. You don't want to go for Dubai, that's a terrible example. Turkey is good in some places, other places not so much. You want to go for the countries like Argentina with its currency crisis, or Cambodia, or even mainland Indonesia. And then finally, work with a team. Not just for buying the property and financing it in the first world country, but also in the developing country. You want to work with at least a local lawyer, one that is independent and creative, that won't send you to their developer friends, that will show you the local market, the secondhand homes that the locals are buying. And by the way, if they're specialized in property, they'll help you find things that you would overlook as a foreigner, such as zoning laws or future infrastructure plans, maybe even geographic trends. For example, you don't want to buy a property in a sprawling desert with little construction bureaucracy, such as Dubai. Maybe a city which is between a mountain and a seaside has more scarcity in the future. Anyway, I made a previous video on how you can cash out crypto through OTC dealers in Hong Kong. You can check it out over there, but That's it for today's presentation. If you enjoy this type of content, you can comment down below or share it with a friend to boost the algorithm. I'll be seeing you though next time, and until then, bye-bye.